Hi everyone, welcome back to Corporate Decoder, the place where we decode those long, boring reports so you don't have to. Today we're looking at a company that's basically a financial blank slate so far. What can we say? Get ready for some thrilling numbers, or maybe just the lack thereof. This report is a quick peek into new Providence Accession Corp 3. It's a blank check company, meaning it's set up to find another company to merge with. So the real story is less about their current profits and more about their hunt for a deal. We're going to dig into their financials, see what they're spending and what risks they're facing. Before we dive in, if you appreciate us making sense of these corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Let's start with what this company is all about. New Providence Accession Corp 3 were set up in the Cayman Islands in December of 2024. They're hunting for a merger, which they call a business combination with one or more businesses. They haven't picked a target yet. In fact, they haven't even started talking to anyone seriously. As of March, they hadn't started doing anything. All their activity so far is about getting ready for their initial public offering, also called the IPO, which is how they raise money from investors. They don't have any real income coming in yet, but they do expect to earn some interest from the money they've raised in the IPO. The IPO was approved in April and they sold a bunch of units, meaning shares with some warrants attached. They made about $300 million before costs, and they also sold some units privately to their sponsor, meaning the people who set up the company. Setting up the IPO wasn't cheap. It cost them about $18.6 million. Most of that went to the banks handling the deal, what are called underwriting fees, with the rest covering other expenses. They have a rule that any company they merge with has to be worth at least 80% of the money they have in their trust account. They also need to own or control more than half of the company they buy. This is to avoid being classed as an investment company, which has a lot more rules. After the IPO, they put over $301 million into a trust account. This money is very safely invested, usually in government bonds, while they look for a company to buy. There's a time limit here. They have 2 years to find a deal, or they have to give the money back to investors. This is meant to give investors comfort that if there's no deal, that money isn't wasted. Moving on, let's look at how they are keeping the books. This report is prepared following official accounting rules for these kinds of reports. Since it's just a snapshot for a few months, it doesn't have all the detail you'd find in a full year-end report. They are classed as an emerging growth company, which gives them a break on some of the stricter reporting rules for a while. They've chosen to take advantage of that break, which means their reports might look a little different from other public companies. Since they have no sales, estimating these things is not possible. They didn't have much cash on hand at the end of March. Most of the money from the IPO went straight into the trust account. They had some money in a bank account more than the insured amount, meaning the bank doesn't have to guarantee if anything happens. Those IPO costs we talked about earlier are being spread out over time in their accounts. What they owe and what people owe them is pretty close to what they're actually worth. They don't have to pay income tax in the Cayman Islands, and they don't have any connection to other countries that would make them pay tax for now. They have to check if any of their financial agreements are derivatives, which are basically bets on other investments. If they have any, they have to value them regularly and report any changes in value. The warrants, which allow investors to buy more shares later, are being treated as equity for now. Since they are a startup with no income, earnings per share calculations will amount to pretty much nothing. They had to start using some new rules for reporting their business segments, but since they don't have any actual segments, it doesn't really change anything. As we've covered, they issued a bunch of shares and warrants in the IPO. The warrants let investors buy shares later at 11 ALS 50 each, but only after the merger and up to 5 years. Their sponsor and Cantor, the bank that managed their IPO, bought some more units privately at the same price as the IPO. These private warrants have some extra rules, like limits on when they can be sold or transferred. Let's see if there are any deals with related parties. The people who set up the company, the sponsor, got a bunch of shares for almost nothing. These shares convert into regular shares when the merger happens. The sponsor lent them some money to cover the IPO costs. They have since paid it back. They're paying the sponsor $20,000 a month for office space and admin support. The sponsor might lend them more money for the merger, and they might be able to convert that loan into private placement units later. Here are some potential problems they see coming. They mentioned the war in Ukraine and the Israel-Hamas conflict, which could hurt the global economy and make it harder for them to find a deal. The people who own the founder shares and private placement units get the right to register their shares with the SEC, which makes it easier for them to sell them later. The banks that handled the IPO get a cut of the deal both upfront and when the merger happens. Digging deeper into who owns the company. They could issue preferred shares, but they haven't yet. They could issue a lot of Class A ordinary shares, but they haven't yet. The founders have a big chunk of Class B shares which will convert into A shares later. Since they don't actually do anything yet, their financials don't have much to say. The chief financial officer looks at general and administrative costs to make sure they have enough money to get a merger done. They signed that deal for $20,000 a month for office space with the sponsor and talk about the closing of the IPO we covered earlier. Now let's zoom out and assess because there's not much to assess. This company is a shell, waiting for a deal. The key takeaway is their burn rate, how much they are spending to keep the lights on. For the 3 months ended March, we see a net loss of about $60,000, all from administrative costs. This confirms this company, like many SPACs or blank check companies, is in a holding pattern. Financial health is determined by deal-making acumen, not necessarily quarterly profit. Their ability to find an attractive company to buy and negotiate favorable terms are the primary factors determining success. The $300 million in trust gives them some flexibility, but high costs or bad deals could dilute that value. Management expects to find and close on a combination with existing capital. Whether those funds prove sufficient to sustain operations post-merger is uncertain. Alright, that's our breakdown of New Providence Acquisition Corp 3's latest filing. There's not a lot to it, but what's your take on blank check companies and their potential? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.